For the longest time, figuring out what a media company was worth was pretty straightforward. You'd look at things like ratings, ad space, distribution, pretty simple stuff. But today, we're going to dive into a whole new kind of company that's basically making those old models look ancient, the individual media empire. And yeah, we're talking about MrBeast.
All right, so let's get right into it. The central mystery we're unpacking is how a business built around just one guy could be worth so much money it rivals huge established corporations. It's a question that's making Wall Street scratch its head and rethink everything it thought it knew about media.
And this is the number at the heart of it all, $1.5 billion. That's the valuation that reports say MrBeast or Jimmy Donaldson was seeking for a piece of his company. So the big question is, how on earth do you get to a number that big? To really get why that number is so shocking, we first have to rewind and look at the old rules. We need to understand how businesses like this used to be valued, which, to put it lightly, was way, way more conservative. And that's really the core of the conflict, isn't it? For a traditional finance person, a business that's so wrapped up in one individual's personality is basically the definition of high risk. So yeah, the word insane gets thrown around a lot because the old spreadsheets just can't make sense of this. Now, this slide is where it gets really interesting because it lays out the huge shift. On the left, you have the old YouTuber model. It's valued at maybe 2 or 3 times its annual profit, basically seen as a risky one-person show. But on the right, you have the new MrBeast model. It's valued like a hot tech or consumer goods company. We're talking 10 to 15 times profit. Investors are willing to pay that much more because they're not just betting on YouTube ads anymore. They're betting on a whole empire of products. So how did he completely shatter that old model? Well, it wasn't an accident. It all comes down to a very deliberate 3-part playbook that's designed to turn a YouTube channel into a massive global company. And this is the strategy in a nutshell. It's a simple but incredibly powerful loop. First, you take all that attention, all those views, and you turn them into actual physical products. Then you build a real corporate structure around the brand so it can exist beyond just one person. And finally, you take that whole machine and you scale it across the entire globe. So let's break down that first pillar because it's the one you can actually see and touch. This is all about consumer products, and the best example, of course, is his snack brand, Feastables. He is literally converting digital views into physical space on a supermarket shelf. And guess what? It worked. Feastables reportedly hit $100 million in annual revenue in its first year. This is so important to understand. It means investors don't see a little side hustle. They see a fast-growing snack company that can compete with the big guys. And that is what gets you those huge valuation numbers we were just talking about. Okay, the second pillar. This one is all about tackling the single biggest risk for any investor, which is what happens if the main guy gets sick, or gets bored, or just decides he doesn't want to make videos anymore. The answer is you turn the one-man show into a real, durable company. And this is the crucial part. It's all about de-risking the whole investment. I mean, when you start hiring former executives from companies like Disney and Nike, you're sending a powerful message. You're no longer just a guy with a camera. You're building a real media company with intellectual property that could, in theory, last for decades, even without its founder. Now let's move to that final pillar, because once you have the products and the company structure, you need to grow. And I mean really grow, beyond just your home country and your native language. This is all about massive global expansion. I absolutely love this analogy from the source material. It just says it all. While a company like SpaceX is launching rockets into physical space, MrBeast is launching dubbed channels into linguistic space. He's translating and redubbing his content into more than 10 languages, taking over new markets at an incredible speed. And in financial terms, what this does is just massively expand his total addressable market, or TAM. He's reaching hundreds of millions of new potential viewers and new potential customers for his products without having to reshoot a single video. It is maximum leverage for minimum cost. And for an investor, a bigger market always means more potential for growth, which justifies a higher price tag. So when you put all 3 of those pillars together, the products, the company, and the global audience, you create something incredibly powerful in the business world, a protective barrier against competitors. Investors call this a moat, and in this new economy, it's an attention moat. The secret weapon in this entire model, the thing that gives him an almost unfair advantage, really comes down to one simple question. How much do you have to spend to get a new customer? In business, they call this customer acquisition cost, or CAC.
This chart shows the whole story perfectly. A legacy brand, let's say a big candy company, has to spend billions of dollars on stuff like Super Bowl ads just to get your attention. MrBeast's ad spend? It's just his video production budget. He acquires customers by making entertaining content, which is so much cheaper and way more effective.
So, what's the end game for this new type of company? It's not just about getting a huge private valuation from some venture capitalists. The ultimate goal, the real prize, is to become a permanent, publicly traded part of the global economy. But first, the whole industry has to solve that one big problem we talked about earlier: key person risk. Right? If Elon Musk leaves Tesla, the company still has its factories and its cars. But what really happens to the MrBeast brand if MrBeast himself is no longer in the picture?
And we're already seeing the financial world trying to figure this out. You've got private equity firms buying up portfolios of faceless channels to diversify their risk. You've got creators issuing bonds, basically borrowing against their future YouTube earnings. But the holy grail, the thing that would validate this entire industry, would be the first major creator IPO on the New York Stock Exchange.
And that really boils it all down to the ultimate takeaway here. The top creators aren't even playing the same game anymore. We're way past just counting likes and subscribers. This is now a race to see who can build the most durable, the most diversified, and the most financially solid media company. Which leaves us with this final, powerful thought. That massive $1.5 billion number, it isn't a bet on how well his next video is going to do. It's a bet on the long-term structural power of a totally new kind of digital monopoly, one that isn't built on oil or steel, but on the single most valuable commodity of our time: attention.